and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
After 2 years of subdued festivities, the markets were once again teeming with keen shoppers last October. Diwali was celebrated with the usual pre-pandemic fervor. And the sales figures which are coming out now are proof of this. Auto sales, for example, jumped by 48%. The festival month saw 18.3% growth in the total non-food credit offtake. Retail loans, driven by a robust demand for housing and vehicle loans, saw an impressive 20% jump. Now, what explains this surge in personal loans? Deepargyo Sanyal's report crunches the numbers for you.
The Reserve Bank of India, or RBI, compiles and releases bank credit figures every month. The central bank classifies this data under two segments, food and non-food credit categories. Food credit is given to the Food Corporation of India and states for procurement of food grains, while other categories of loans come under non-food credit. According to the latest RBI data, the non-food credit offtake remained robust across sectors, industry, services, and retail in October. Non-food bank credit rose to 18.3% in October 2022 as compared with 6.9% a year ago. An analysis of absolute growth credit between October 2021 and October 2022 indicates that four segments, NBFCs, large corporates, trade, and home loans together account for 51% or 95.5 lakh crore rupees of the total 18.8 lakh crore rupees lent by banks during the period. Personal loans expanded by 20.2% in October 2022 as compared to 12.6% a year ago. It was largely driven by housing and vehicle loans. Housing loans jumped by 16.2% to 18.25 lakh crore rupees in October this year as against 15.71 lakh crore rupees a year ago. Credit card outstanding also soared by 28.4% to 1.79 lakh crore rupees, a rise of 62,000 crore rupees in a year. Vehicle loan outstanding rose by 22.1% to 4.61 lakh crore rupees from 3.77 lakh crore rupees a year ago. The rise in personal loans is complementary to the recent GDP data, which shows that private spending has remained robust over the past 2 quarters. It was above 20% in Q1 and fell to 9.7% in Q2. So what are the key factors driving personal loans and private spending, and why has spending fallen in Q2?
Now, rightly pointed out, inflation has continued to remain high, elevated. But what has driven personal loans is largely the resumption in services, the complete opening up of the economy after the pandemic. Added to that, we saw a very healthy festive season demand coming back to the economy almost after 2 years of being subdued demand growth in during the pandemic. And not to forget that personal loans also incorporate not just housing and vehicle loans, where we did see traction coming in, but also they incorporate education loans, where we did see students now moving out of the country could have tapped on to higher education loans with travel restrictions being lifted. And also there's another category within personal loans, which is other personal loans, which is largely consumption oriented loans, which could be for, say, for the purpose of marriage, could be for purpose of medical, could be for purpose of travel, etc. Consumption is bound to take some hit, urban consumption more so, from the hike in the monetary tightening that we have seen. The past impact of cumulative monetary tightening of almost 190 basis points has so far not trickled down to the consumers, which is going to have a lagged impact going forward. So that definitely is going to be one reason. The other reason, obviously, is that the pent up demand that has so far supported the economy cannot continue unfettered. So there is only a certain limit to which consumers will consume uh, consumer durables or services, and there wouldn't be a continuous repeat fashion of consumption on those fronts.
Credit growth to industry, however, rose only 13.6% in October 2022 from 3.3% in October 2021. Size-wise, credit growth to large corporates increased by 10.9% against a contraction of 0.4% a year ago. The share of loans to the industry sector in bank credit has shrunk to 25% from 27% in the same quarter last year. Medium industries recorded credit growth of 31% in October 2022 as compared with 35.1% last year, while credit to micro and small industries rose by 20.4% from 14.6% a year ago. So why isn't the industry buying more?
I think when you look at on a relative scale, shares do indicate a decline in industry, but I think that's also relative. If you take a deep dive into industry growth numbers and how credit has grown for industry, I think that is also a very interesting trend where we see growth in within the industry also rise a very healthy credit growth offtake that the industrial sector has witnessed, and a large part of this of late has been driven by credit offtake to large enterprises. So there are two other important reasons. One, obviously, is the need of working capital that has gone up amidst the rise in commodity prices that we've seen. Second is that there has been a fair degree of substitution in demand for credit away from capital markets in favor of banks.
The slow rise in industry credit offtake does not match the steady investment numbers. Investment grew by 10.4% in Q2. Government spending too fell by 4.4%. What has then been the major source of investment in the Indian economy? And going forward, a contraction in manufacturing and global slowdown effect may put a question mark on demand in the second half of the ongoing financial year.
Domestic air traffic also rose by 10% in October, with 11.4 million people thronging airports across the country. Meanwhile, the entry of the mighty Tata Group is making waves in the aviation sector, which is staring at a consolidation now. India's second largest airline, Vistara, will soon fly into history. It is being merged with the Tata owned Air India. But apart from the opportunities, what challenges will this merger pose, given the distinct work cultures of the two airlines? Will it be a smooth ride for Air India? Bhaswar Kumar caught up with three experts to bring you the answers.
Hello and welcome to Business Standard. Today, we have with us experts from diverse fields who will help us delve into the challenges that would emerge from the merger of Vistara with Air India. We have with us Vinamra Longani, the head of operations at Saran & Co., a law firm specializing in aircraft leasing and finance. Nirmalya Kumar, a management expert and the Lee Kong Chian Professor of Marketing at Singapore Management University. And Harish Bijur, a business and brand strategy expert and the founder of Harish Bijur Consults Incorporated. Hello and welcome. With the merger of Vistara with Air India, would it be correct to say that Air India is now a Tata Singapore Airlines joint venture?
Managing any joint venture doesn't matter which industry is challenging. In the case of Air India, Vistara, or whatever the Tata Airlines is called in its various functions, is going to be much more challenging for a very simple reason. When a company is making loss and you do a joint venture, it means you require continued infusions of capital to meet the operating expenses. And this is where the problems start arising, because if one partner wants to grow faster than the other in a loss-making business, It's even problematic in a growing business if capital is needed, but in a loss-making business, it becomes especially challenging, because in some sense, what Singapore Airline has done is that it signed up for several years of losses that it has to fund. And the question is now going to be as to whether the projections of losses are going to match what the actual losses happen.
In my opinion, what the Tata Group and Singapore Airlines have gone and done is they've, by merging these two airlines, two full service airlines, which continue to make losses. I mean, Vistara's lost over $1 billion in the last 7 or 8 years that they've been around. So what they've done is they've plugged their losses in a way to make sure that they don't compete with each other. So Air India would be a Tata Singapore Airlines joint venture, but one where Singapore Airline has a vastly reduced shareholding. You see, at Vistara, they had a 49% shareholding. Once the merger completes, it'll be down. I mean, in the larger Air India, they'd have a 25.1% shareholding. So you see, we're talking about two people who have the wherewithal and who want to make who want to make a mark in the Indian aviation space. So yes, I mean, operationally, they worked together before, and one would like to think, given their long-standing partnership in Vistara, that they know what they're doing and they know what they're getting into. But I see they're both committed, and that the wherewithal and intent to run a good airline should sort of help them sail through.
It is hoped that the combination of Air India and Vistara will bring in significant synergies. At the same time, would you say that one of the challenges emerging out of this merger will be to manage different organizational cultures? So how do you see these synergies and challenges playing out?
You have to remember, I was there in the room with Ratan Tata and Cyrus Mistry and the CEO of Singapore Airlines the day the decision was made to enter the airline business for Tata Group. And I said no to it and almost got fired on the spot for that. Okay. And the reason I said no to that was, I said, firstly, 3 things you have to remember. Number 1 is there is no airline companies only make profits under 2 conditions. First condition is, having been in the airline industry for 30 years, I can tell you, first condition is you make money if you're a low cost player, like a EasyJet, Ryanair, Southwest Airlines, you make money. Second is, if you're a full service airline, you only make consistent, sustained profits if you're in a country where there is no unions. Otherwise, there's no money making process in the airline industry, as far as I know. There'll always be volatility. Second point you have to remember is, and the reason I was against going into the airline industry was, I said the largest airline, the most successful airline in the world, even if assume we build the most successful airline in the world, has a market cap of about $15 to $20 billion. Given that at that time, the Tata Group market cap was 140 billion and our 2025 goal was 350 billion, I said, we're getting into the airline industry is a waste of my time because I'm not going to ever get to my goal, building airlines of $20 billion industry, at a time. The second thing I want to say is that hope is not a strategy. Okay, hope is many things, but it's not a strategy. There is no strategic path to profitability for this joint venture at the moment. Okay, and building a culture in a new airline is possible. Building a culture by merging 2 existing airlines is not possible. There has been no example of a successful merger in the airline industry, as far as I know. Okay, there have been attempts like the Lufthansa, Air France, KLM, all of these guys, but there has really been no successful attempt at a merger. Why? Because service cultures are much more difficult to merge than product cultures. So now the question is, does Tata Group and Singapore Airline have the degrees of freedom to fire everybody and start anew? I doubt it very much, right? In a country like India with very strong labor laws. So good luck is all I would say. And please remember one thing, hope is not a strategy and you can't whip a dog and make it a horse.
May I just quickly add to that? Because Nirmala has raised very pertinent points there. You see, we don't really know what the strategy around this sort of mega merger is, but at least from what we know right now, you see, they've announced this VRS for a lot of older Air India employees. It was a couple of thousand people, as reported widely, have accepted the VRS, and you see people are starting to leave now. At the end of the day, the old seems to be at least on the way out, with the intent that, we need to get new blood to sort of turn this around. How this pans out is anyone's guess.
So, Harish, the merger effectively means the phasing out of brand Vistara. But the commentary around the decision had pointed out that Vistara had actually started enjoying a certain amount of premium for its service quality and brand recall. So, what does this mean when it comes to brand building?
If you ask me, this merger between Vistara and, of course, Air India, with just a single brand name at the end of 2024, is all a kind of a David versus Goliath play for me. For me, David in this space is really Vistara. And Vistara is an airline which cobbled together for itself a gold standard kind of an appreciation within India for sure. It's really all about saying that, an airline which was put together with a certain degree of passion, which is Vistara, which developed into a kind of a passion statement, which developed to be the gold standard of a good airline within the country in a very short tenure, is now getting merged within an airline which lost it all for a long, long period of time. So what's happening is a superior brand image airline gets merged into an inferior brand image airline, and all of it becomes Air India, maybe by end 2024, as we're talking today. What really happens here is there's going to be no David, there's going to be Goliath, which simply means to say that the Air India is going to be the brand. Whatever Vistara put together, cobbled together, is going to be a small part of the big Air India. And well, again, the word hope, inverted commas, is that, the Vistara culture is going to seep into the Air India culture. There is at one end something called brand romance, and at another, there is brand reality. I think merging Vistara into Air India is biting into brand reality. Now, brand romance has a way of lasting for a limited period of time. When the romance wears off, it's only business reality that bites. I think the Tatas have bitten into the business reality side of it. And I do believe that's what's going to lead the way. Well, one looks forward to see how this is going to pan out, how Air India is going to create that mega feel for itself, that passion for itself, that gold standard, if not the platinum standard of running an airline, which JRD envisaged for the Tata airline when he started it.
There you have it from the experts. Air India's flight route could be fraught with pockets of turbulence. The merger concludes in 2024. You can imagine a lot of fingers will remain crossed to see if the Maharaja, armed with the might of the Tata Group, can reclaim its crown.
After going through the roof, the prices of jet fuel are coming down now, in a breather to airlines. But it is not easy sailing for the common man. The price of natural gas is still burning a hole in the pocket. A government-appointed panel of Kirit Parikh has given a set of recommendations to reform the natural gas pricing regime. It wants to do away with the existing norms where prices are fixed in tandem with global markets. This may bring some relief to us. But how will these reforms affect companies in the sector? We find out in our next report.
To provide relief to consumers reeling under high energy prices, the Kirit Parikh panel on Wednesday proposed a set of reforms in the natural gas pricing regime. The panel suggested a floor and ceiling price cap of $4 and $6.5 per metric billion British thermal unit or MMBTU for natural gas extracted from oil fields, and said that the actual price within this band will be linked to the imported crude basket. It also batted for complete deregulation of gas prices by 1st of January 2027. Analysts say the recommendations, if accepted by the government, will likely bring short-term respite to city gas distribution companies whose margins are being impacted due to higher sourcing costs. But gas producers like ONGC and Oil India could see a negative impact.
If the Kirit Parikh committee recommendations are accepted by the Union Cabinet, the move on the face of it seems positive for CGD companies in the near term and marginally negative for ONGC and OIL. CGD companies will have the flexibility to cut prices of CNG/PNG by 20 to 25%, thus making them competitive against alternate fuels like petrol, diesel, and LPG. The formula suggested by the panel for determining the price of gas based on imported crude oil price is not public so far and will need to be examined to judge the final winners.
Sharing similar views, analysts at Prabhudas Leeladhar say that the capping of prices will especially be positive for Indraprastha Gas and Mahanagar Gas, as the domestic gas output accounts for 90% of priority sector, that is CNG and PNG demand. At a cap price of $6.5 per MMBTU versus the current $8.57 price, retail CNG prices could go down by 7 to 8 rupees per kg. Margin expansion for CGD companies will depend on the extent of passing on the benefit of lower gas prices. Meanwhile, at the bourses, shares of Indraprastha Gas, Mahanagar Gas, Gujarat State Petronet and Adani Total Gas have surged up to 69% so far since April. Nifty 50 is up by 7% and Nifty Oil and Gas indices by 9%. Meanwhile, gas producers such as ONGC and Oil India are likely to record lower gas realizations due to the suggested price gap. As per Care Edge ratings, the price of domestic gas would have been $10 per MMBTU for FY24 based on the existing formula. The new proposed prices, it estimates, could lead to a loss of up to 23,000 crore rupees in FY24 for oil-field gas producers. Besides, the long-term impact of the likely reforms on the oil and gas sector will be fully ascertained only in due course, analysts say. That said, the street will take cues from global peers for direction today. Globally, investors will closely monitor US job report later in the day.
Meanwhile, in another piece of good news, researchers in China's Yunnan University have finally achieved a breakthrough in developing a rice variety which does not need to be planted every year. Once grown, it can be harvested for the next 8 seasons over 4 years. Our next report has more on this.
At first glance, it looks like wild grass or some weed due to thick tillers and dense roots. But it is a variety of rice which, in all likelihood, may change the way the crop is being cultivated for centuries. It may also help us fight climate change and save an unthinkable amount of money we spend on labor for sowing rice every year. This variety of rice, which was invented in China, is now evoking curiosity around the world, where over 3 billion consume it daily. After decades of research, scientists in China have developed this strain of perennial rice. Once sown, PR23, as it is named, yields 8 consecutive harvests for over 4 years. The number of farmers switching to this variety of rice is growing by leaps and bounds in China. In 2020, about 11,000 small farms planted this variety in 9,000 acres. Last year, the planted area quadrupled to 38,000 acres. So how was it developed? A Yunnan University research group led by Shilai Zhang worked for years on this and grew thousands of rice varieties from hybridization. They were trying to find a strain that was perennial yet also delivered good harvests. We failed again and again, Zhang wrote in his research paper later. But finally, they found that perfect strain by hybridizing a regular rice variety with a wild African strain of perennial rice. The resultant variety lasts for years and requires 58% less labor, 49% less input costs when compared to regular rice. Perennial means lasting forever, or at least for a long duration. The wild African perennial rice on its own grows again after the first harvest. This reduces the labor and input costs, but its yield is low. On the other hand, the regular Asian rice is a short-lived variety but with a high yield. The breeding of these two varieties resulted in PR23. This variety yields harvests similar to the regular Asian crop, and it continues to do so for at least 4 years. This perennial rice is also environmentally friendly. Research findings showed that over a period of 4 years, soil accumulation was higher as compared to regular rice. Greater accumulation of soil prevents soil erosion. It was also found that it trapped more organic carbon and nitrogen, both of which are essential for soil health and plant growth. More importantly, researchers found that the water holding capacity of the plants increased. Soil pH levels were also found to be increased. All these findings suggest that the perennial rice is an all-rounder. Once PR23 is sowed, it does not require resowing. Consequently, the field does not need to be ploughed either on an annual basis like other crops. While this saves on labor costs, it does bring a different set of problems. Less tilling leads to the growth of fungi and pathogens. Insects tend to persist after harvest, since unlike regular rice, the field is not ploughed under. These insects, along with other pathogens, can transmit viruses to the regenerating sprout in the following season. It was perhaps for this reason scientists found that PR23 required more herbicide treatment than regular rice. Further, with less costs, the risks are also high. If the perennial rice yield falters, then a huge amount of work is needed for resowing. This is because the perennial rice develops very strong and deep roots which need to be killed for resowing.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Researchers in China have been working to develop this variety since 1970. The first breakthrough came in 1996, but the variety was not suitable for large-scale production. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll be back on Monday morning. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.